Hello, I'm Michael Hainsworth. Bullet dodged. That's how the country's tech community is reacting to news that the federal Liberals have prorogued Parliament while it searches for a new leader. Justin Trudeau's decision to step down scraps all legislation on Parliament Hill. The changes would have raised the portion of capital gains on which companies pay tax from 50% to 2/3, and it also applied to individuals with capital gains of more than $250,000. The tech bros aren't the only ones relieved. But what's the big deal if a bunch of rich nerds have to contribute more? Jack Vince is with the School of Public Policy at the University of Calgary, and Alexandre Laurent is the Vice President and Director of Research at the Stady Howe Institute. They join us now. Thank you for joining us.
Pleasure.
Alex, you and Nick DeHere at the Institute wrote back in October, don't count capital gains tax revenues before they hatch. Now, you've argued in the past that even if the legislation had gone through, you really can't rely on revenue from a capital gains tax.
Yeah, there was a bunch of estimates that had been done estimating the amount of personal income tax revenues that would be raised by the capital gains tax change. The first was the budget estimated over 5 years, because that's the budget horizon is 5 years. So over 5 years, the capital gains tax would raise over $8 billion. Then the PBO at its own estimate, it was a bit lower at around $5 billion. And then we made our own estimate, and we arrived at $3 billion over 5 years. So that's not a lot of revenues. That's only from the personal income tax side, I should say. Jack's gonna talk a little bit more about the corporate side, maybe not the exact revenues raised by the proposed change, but our study, we concentrated on the personal income tax side, and so we estimated that it would not raise that much revenues, like $3 billion over 5 years. It's not that much, and the main reason, if I may go there right now, the main reason was the alternative minimum tax. There had already been a change to the alternative minimum tax, and that's the topic of a study that we did last year. And the alternative minimum tax actually does already target those large gains that are the target of this capital gains tax increase. So a lot of the revenues, and the alternative minimum tax is a backstop. Like, you only pay it if, once you do the calculations, you end up owing more in alternative minimum tax than under the regular tax. So it's a backstop. But that backstop, the way it's now configured, it's really targeting those people that have occasional gains that are really high. And by really high, I mean $500,000 capital gains and more. But they're also the target of that new capital gains tax increase. So the new capital gains tax increase, it does raise a lot of revenues, but you're losing the revenues that were already counted in the budget horizons, those revenues from the new alternative minimum tax. So one tax, the revenues from one tax will be lower, revenues from another tax will be higher, but in net, it's not that much more revenue. So that's, in a nutshell, that's what our study showed. It's that, you're not going to raise a lot of revenues from that at the personal level from that tax, over and above what was already planned in the budget horizon.
And Jack, I suppose ultimately what Alex is saying also applies to the corporate world too. Like the concern about capital gains taxes is that if you focus on that as a revenue source, it's a really lumpy way to bring money in the door.
Oh, it is a lumpy way, but it's also a very complicated story to tell. But as Alex pointed out, as he did carefully looked at something like the alternative minimum tax and found that you don't raise that much money because of these offsetting losses. I could actually go into some other potential losses, which is partly related to the work that I did, and in particular, the impact on the economy when you have a loss of investment. and a loss in GDP, you're going to end up losing a whole bunch of different revenues as a result, which has to be considered as well. And so the impact on revenues is very complicated. And on the corporate side, this is a very understudied area of taxation when it comes to capital gains taxation. I've been working with a research assistant over the past while, and it's been very amazing, actually, how few papers have actually been written on corporate capital gains taxes and their impact. And in fact, there's been really nothing done in Canada. But when you do look at the corporate side, of course, corporations are going to be paying more capital gains taxes on all their capital gains. There's no exemption for $250,000. And of course, that affects not just all the private corporations, which will be affected in that sense, but also will impact public corporations as well. And so what we've done actually is shown that there's actually to be an impact in the cost of capital, or the cost of investment for corporations. And that impact actually will be a loss of roughly $120 billion over time, in the sense that, once you put a shock to the system, it takes time for it to work through the system. But within 5 years, there'll be a loss of GDP of about $120 billion, or about 3% of our current GDP levels. So I think that's something to also remember, because that's going to have not just an impact on people's lives and their incomes, et cetera, but it's also going to impact governments in terms of revenues.
So you argued in the Financial Post when the announcement was originally dropped that, quote, history repeats itself, first as tragedy, second as a farce. I can imagine, as I pointed off the top, bullet dodged?
We don't know what's going to happen yet in terms of the next while. And this is part of the chaos now that we're in with respect to capital gains taxation. So there was a Ways and Means motion that was brought in, with respect to the spring budget that introduced the capital gains tax increase, which is basically a statement of intent by the government to change the law. And of course, now with prorogation, we did. And I should say there was never legislation introduced, so we have never seen the legislation actually being gone to, let's say, a second reading or whatever, or even a first reading. So we haven't seen that legislation. And now, so it's not a matter of the legislation dying with prorogation, it's just never been there. And so now after the government comes back on March 25th, it could introduce the legislation at that point, but then of course it depends whether it survives or not. And if it doesn't survive, and there's another election, or there is finally an election, let's say in the spring, we may not even see the capital gains tax increase. In the meantime, the Canada Revenue Agency has been administrating the capital gains changes as if they've already been passed by law, which of course they haven't. But that is a practice that they would normally do because many budgets often introduce changes and then legislation's not passed until a later time. But with majority governments, they tend to be, passed, and it's not a major issue. But in this case, we have a total mess in a way, in the sense that the Canada Revenue Agency is collecting taxes based on the new law. And of course, if people don't comply with the law, they could be subject to interest and penalties if the law is eventually passed. But on the other hand, if the law never sees the light of the day, then the Canada Revenue Agency is going to have to be paying refunds back to people. And this is going to have an impact, not just in terms of federal revenues. So all that money that the federal government booked, which was close to $20 billion over 5 years, as Alex said, that may be an overestimate, but actually we'll see depending on what the refunds are. But if that money is actually returned, not only will the federal government be out of revenues, but so will the provinces. And so this is going to be a very significant problem that both the federal and the provincial governments could be facing in terms of the impact on their deficits, particularly. And as we know, some provinces are having extraordinarily bad time in terms of deficits, particularly British Columbia.
So, Alex, Jack's brought up a very important point about the corporate world having to make decisions based upon what they anticipated would come to be, which does not look like it will come to be now. Were there similar sort of implications on the consumer side of things? Like, I don't know a lot of people who would have been impacted by this particular decision with that $250,000 cap.
Yeah, it's not. It is not a lot of individuals, but it's still many thousands that are impacted by the change, even though there's a $250,000 exemption. But it like Jack points out in his paper, longitudinally, year over year, it's a few thousand people. Like I think it could be up to 10,000 people, 14,000, whatever the number per year. But it adds up because it's not the same people year over year that are being that actually do realize very large capital gains. It's like we just discussed, it's a very lumpy business to be realizing very large capital gains because you need to have an asset that has appreciated by that much. So and sometimes it takes a lot of time for an asset to appreciate by enough to realize the $1,500,000 capital gains. Like, the thing with capital gains that we haven't talked about yet is their distribution. It's very unique. Capital gains are concentrated at the top, meaning that I'm trying to remember off the top of my head, but it's definitely the majority of the capital gains that are being realized and included in tax returns. That's at the personal level. I'm not talking about the corporate side at the moment, just at the personal level. The majority of the capital gains that are being included in tax returns and generating tax revenues are actually very large capital gains. So it's really skewed towards the top. So let's say like there's a low number of people realizing very high capital gains of $1 million, where these people may generate 60% of all of the capital gains being included in tax returns year over year. So it's a very small number of people realizing very large capital gains that account for most of the revenues from the tax. But it's not always the same people year over year. They're different people. So and if you look at Jack's paper, he came up with an estimate. Year over year, it's not always the same people. So like, let's look over a large number of years to see how many taxpayers overall will be affected by that. And his estimate is about 4% of taxpayers over a large number of years. So that's a significant number of people, but it takes many years to get to that 4% of taxpayers.
Well, let's expand on that, Jack, because you did predict that 1.25 million Canadians will make a capital gain greater than $250,000 in their lives. So that's basically 1 in 40 Canadians. Wouldn't that apply only to second homes or made post-retirement and therefore subject to a lower tax rate?
Yeah. So first of all, I think it'd be important to kind of explain circumstances in which people end up realizing their capital gains. So first of all, there are people that hold shares in the market and they might sell their shares. Then of course they'll pay capital gains taxes. And that's the one that often people think of as, let's say they're relatively well off. They have a lot of money in the stock market, so therefore they're getting a lot of capital gains year over year, although even that's not true because, as we know, there's often a buy and hold strategy when it comes to holding assets, and people don't always sell off their assets every year, year by year. But the other circumstances are usually just, maybe once in a lifetime or twice in a lifetime situations. Of course, once in a lifetime is when you die. At that point, your estate is going to be valued, and there'll be deemed realization of capital gains on the estate, and so that's a one-time event. And that will actually appear in the data. Another type of event is when you sell a cottage, and then you'll you could have quite significant capital gains because you may have bought the cottage in 1980 and you're selling it, let's say, in 2025. And there could be well over $250,000 in capital gains in selling your cottage. It's not unusual. And then, of course, there's a case where people own small businesses, whether they're corporate small businesses or unincorporated ones, and they're selling off assets in that case. But again, it's kind of a one-time or not a very frequent thing that you do during your life where you end up selling your shares in his small business or pass them on to other people. And then, of course, all that is even more complicated because there's a lifetime capital gains exemption. So we're talking about capital gains that would have to be in excess of that exemption as well, et cetera. So evaluating actually the impact on individuals is somewhat complicated. But we had some data that we had on longitudinal data. Roughly every year, there's about 40,000 taxpayers actually that report capital gains in excess of $250,000. But what we found is that almost 2/3 of them only did it once over a period of 2011 to 2021, which is what this data covered. And then and then there were only another about 15% that actually had capital gains in excess of $250,000. That was twice during that 11-year period. So we're talking about most people, in fact, 4/5 of people, tend not to have significant capital gains every year. In fact, they only do it very infrequently. And so what I did is I sort of said, okay, like on a lifetime basis, if we take assumption about how long people typically live in terms of when they first become, let's say, taxpayers, they start working, then they potentially pass away at some point. That's how I ended up estimating 1.25 million people based on what you might call life incidents, where at some point they're going to end up paying this additional capital gains tax rate, which is a lot more than what the government professed in terms of this 40,000 that they had estimated. By the way, I got that same number that I had. So I think we do have to remember it was much more pervasive than what it thinks. The other point that we found is that when you have capital gains that are large in 1 year, you're going to look like a high income taxpayer that year. The question is, are you a high income taxpayer every year? Well, if you only get a lumpy amount of capital gains in 1 year, then it may be that if you didn't have that capital gains, we'd like to kind of know what your income would be. And we actually found that the median income of those households that were claiming $250,000 or more in capital gains, if you take away the capital gains that year, their average income was $100,000, and the median income was $100,000, which means there were a lot of people below that that certainly weren't rich, but they were getting one-time significant capital gains, like selling a cottage or passing away or whatever.
I don't profess to know what went on in the hive mind of the PMO when they made the announcement in the first place. But Elon Musk, Jeff Bezos, they're the poster boys for extreme wealth. Even Galen Weston Jr. and others are fueling middle-class calls for heads on pikes. The robber barons of the 1930s saw the guillotine blades being sharpened and poured millions into public spaces like libraries and opera houses. And this was when the marginal tax rate was 63% in the States. How do we get the wealthy who have benefited from stock market expansion, housing market advances, to contribute more if it's not through a capital gains tax?
Well, I think, first of all, there's a big difference between the United States and Canada. U.S. does have an estate tax that we don't have. And of course,
Is that a solution?
It may or may not be a solution. It's very, one of the things in the U.S., they don't have demutualization of capital gains at death, unlike us. And so we do have some capital gains tax, or some estate tax in that sense. In fact, we originally, back in 1972, when we brought in capital gains taxes, the federal government also dropped estate taxes rather than have two taxes at time of death. And so one was really a substitute, or a bit of a substitute for the other. So we have to take that into account. Also, we have to remember the U.S. You really do have these mega billionaires and mega billionaires. In fact, the amazing thing about the U.S. is that you now have $1 trillion companies. It's the only, they have 6 or 7 now that are worth $1 trillion. That's exceptional. You don't find that in Europe, and you certainly don't find that in Canada. So you really do have these mega wealth cases. Now, in terms of Canada, we have our very wealthy families, and there has been, taxation that we have not, been sufficient. And so the question is, how do you do that? Now, now we have to remember this. It's kind of a complicated world. When people get capital gains on selling their shares, they've already paid a tax on those capital gains. It's called the corporate income tax. When the corporation pays corporate income tax, the actual capital gains is less than it would be had there been no corporate tax. So you have to remember there's an underlying tax that had reduced some of those gains already. And the reason why we've had a partial exclusion of capital gains was to recognize the fact that there has been some corporate tax already paid on that income before people receive it. And so then the question is, how do you apply the tax? And you can argue that one of the important ways, which we adopted in 1972 for individuals, is to make sure that the top dividend tax rates was roughly equal to the top capital gains tax rate in order to minimize tax planning opportunities. People would try to pass out their income in the form of either dividends or capital gains, depending on which is more heavily taxed. And that's been a policy that has been an objective since 1972, although I wouldn't say that it has been followed all the time in Canada. And in fact, right now, the capital gains tax rate on realizations is significantly lower than dividend taxes at this point, both on private corporate dividends that are paid out, plus other corporations that pay out their dividends. And so there's a real incentive to pay out capital gains and to try and get capital gains passed on to taxpayers as opposed to dividends. And so there's a very strong argument to at least try to even that up. But the problem is, this is the corporate ones, because at the corporate level, corporations pay capital gains taxes, but they don't pay taxes on dividends they receive from the corporations because those dividends have already been taxed. And so we're trying to avoid, putting heavy taxes at corporate groups as money flows through corporate groups. And so when we raise the corporate capital gains tax rate, that actually creates a different kind of distortion, where actually we are more heavily taxing one source of income, capital gains for a corporation, as opposed to other sources of income, dividends particularly. So that is a problem that you get with increasing the corporate capital gains tax rate. And then there was a third one introduced by this budget, which we've never done before, and that is have a different capital gains tax apply to personal capital gains as opposed to corporate capital gains. Normally, they've been treated the same because the idea is that people could try to avoid paying personal capital gains if they hold their shares in the corporation. If you didn't have a corporate capital gains tax rate, you can avoid personal capital gains taxes by putting them in the corporation, let the corporation sell assets and never pay the capital gains tax rate. And so we've had an equal or a similar personal tax on capital gains versus a corporate capital gains tax rate. And what that has done actually is it has the new rules with this $250,000 exemption actually will encourage people to hold shares as individuals and not through their corporations. So it introduces a whole new distortion that we've never had, which is the thing that I didn't like about the budget proposal, that it actually introduces a distortion we never had in the system before. And so I think we need to sit back, in my view, and try to look at all this and look at a much larger tax reform where we have personal tax rates that are too high now at the top end, well over 50%, one of the highest net in the G7 countries. And I think it's about time that we made changes also with respect to other aspects of the tax system. Is an estate tax or a wealth tax appropriate in order to get at the very rich? Or should we just have a super rich type marginal tax rate, which rather than at $250,000 roughly. When you're living in a city like Toronto or Vancouver, that's not a very high tax, very high level of income, especially if you're a single learner with a couple of kids and you're supporting a family and you have leases and everything else to pay for. So I think we need to sit down. I think we need to have a much larger tax reform and open up the question about how best to achieve the kind of objectives we want. And I think this particular capital gains tax rate change was a poorly done one. And frankly, I hope it doesn't see the light of the day.
All right, let's whipsaw from a detailed answer to one that might be a little more social media friendly. The RIT.ca poll shows the Conservatives under Pierre Poilievre have a 24-point lead over the Liberals. If an election were held today, the party would win in a landslide. What would be your revenue-generating advice to the next Prime Minister?
I am convinced that policies where we try to be the average around the world is not going to really help us very much. I think we need some sort of big bang tax reform. And I can go into a lot of discussion about what elements that would include. But I think we need to think a lot more braver about our policies, because we're living next door to the behemoth.
Yeah, we need another tax commission that would review the tax system overall. Even if it takes a few years, it doesn't matter. We could get it right by having a tax system comprehensive commission. And in the meantime, we need to cut spending.
Gentlemen, thank you so much for your time and insight today.
You're welcome.
Thank you.
Jack Mintz is with the School of Public Policy at the University of Calgary, and Alexandra Laurent is the Vice President and Director of Research at the C.D. Howe Institute. For further insight into Canada's tax landscape and how the next government should address revenue shortfalls, visit cdhowe.org. I'm Michael Hainsworth. Thanks for joining us.
You've been listening to the C.D. Howe Institute podcast with Michael Hainsworth. Subscribe on iTunes, Google Play, and Spotify. The C.D. Howe Institute is an independent, not-for-profit research institute whose mission is to raise living standards by fostering economically sound public policies. The Institute is widely considered to be Canada's most influential think tank and a trusted source of essential policy intelligence, distinguished by nonpartisan, evidence-based research and subject to definitive expert review. Visit cdhowe.org and follow us on Twitter and LinkedIn. Thank you.